In this module, we are introduced to the cost volume profit model. Now, in the last module, we talked about understanding our costs and how they change with volume. We introduced contribution margin. We will go over those concepts again, and we'll now look at it in terms of what kind of profit we can predict will happen if we know what our costs are and we decide what kind of volume of activity we plan for the future. So cost volume profit is a study of the effects of changes of the costs as they change with volume and how that affects profit. It is very important for profit planning. It also helps management set selling prices, determine product mix, and maximize the use of production facilities. There are 5 basic components. First, we have to focus on the level. What level are we talking at? Then we look at the unit selling price. Now the level could be sales or activity. Unit selling price, the variable cost per unit, the total fixed cost, and the sales mix. In a later module, we'll deal with sales mix. We'll focus right here on the first 4. Now notice when we talk about costs, variable costs are expressed on a per unit basis, total costs or fixed costs are expressed as a total. Now there's some basic assumptions here. Behavior of costs and revenues are linear. All costs can be classified either into fixed and variable. All units produced are sold. Now the first thing to do is develop what's called a cost volume profit income statement. Now we're not creating an income statement, we're taking the original income statement and reformatting it into those costs that are fixed and those costs that are variable. And then determine what the contribution margin is. The contribution margin is the revenue that remains after deducting the variable costs. So we're not changing the income statement, but the way it is now, it is of little use to management. So we rearrange it, and this is only for internal use. Here is an example. We have Vargo Video, and the relevant data is it has a unit selling price 500, variable cost of 3, total monthly fixed cost of 200, and they're selling 1,600 units. So therefore, the contribution margin statement simply has sales minus variable costs, which then shows me what the contribution margin is. And the contribution margin is what's left over to cover the fixed. Once the fixed is covered, what remains is net income. So there you have the total contribution margin. Here we have, or we're going to look at the contribution margin per unit. Contribution margin is what is available to cover the fixed cost and contribute to income. Now, the contribution margin per unit is simply the unit selling price, 500, minus the variable cost, the unit variable cost of 300, which gives me a contribution margin per unit. So now, I have, for every unit that I sell, in comes $500, out goes to cover the variable cost $300, and the $200 is left to cover my fixed costs. And therefore I look and I say, okay, my fixed costs are $200,000. Therefore, how many units will I have to sell in order to cover my fixed? And that is break even. Break even is zero profit. And if I sell 1,000 camcorders and I have a contribution margin of $200 per unit, then my total contribution margin will be $200,000, and my fixed, that covers exactly my fixed. And the next one I sell, I have more contribution margin than I need to cover my fixed. So what is left after I cover my fixed is net income of the contribution margin. Then we look at the contribution margin ratio. Quite often this is very useful to us. And any time in business, when you're talking ratio, it always means a percentage of sales. Gross profit ratio is gross profit as a percentage of sales. Net income ratio, net income as a percentage of sales. Contribution margin ratio, contribution margin per unit as a percentage of selling price per unit. And that way I get 40%. 200 divided by that. So now the contribution margin ratio, you see, 40% will tell me exactly how many cost it. I make 40% on them. Now what would happen if I was to sell more? A 200 unit increase or $100,000. Well, as you can see, if sales goes from 500 to 600 and my contribution margin ratio is 40%, then my profit's going to go up 40%. I'm beyond break even. So my profit will go up 40% of that increase of the 100,000. So that's the usefulness of the ratio. Break-even analysis, the process of finding that point where total revenue equal total fixed costs. And it's expressed either as sales units or sales dollars. Now, when we talk about using the contribution margin technique to determine the break-even, then we want to find out what the total contribution margin is, and that would be total revenues minus variable costs, and then relate that to the fixed costs. So now there are two techniques. If I'm going to use the contribution margin per unit, then my answer will be expressed in units. So therefore, the break-even is the fixed cost divided by the contribution margin per unit, and break-even in units is 100,000. Now, if I sold 100,000 at 500, my break-even in dollars, sales dollars, would be 500,000. But if I wanted to calculate that break-even in dollars, I take the fixed cost, just as I did before, but this time I use the contribution margin ratio, 40%, and I will get the break-even in dollars. So to repeat, to get the break-even in units, you divide the fixed cost by the contribution margin per unit. To get the break-even in dollars, you divide the fixed cost by the contribution margin ratio. Here we have a company, unit selling price 400, variable cost per unit is 240, so the contribution margin then is 160. Fixed cost is 180. Therefore, compute the break-even in units using the contribution margin per unit. Fixed cost, 180, divided by 160, and I get a break-even in units of 1,125. So you see how useful the contribution margin per unit is, and the contribution margin ratio. Now, that gives me break-even, which is zero profit. However, I'm interested in earning a profit. So the target net income, then, is that level of sales that I need to achieve in order to get that target net income. And it's either expressed again in sales units or sales dollars. So therefore, I need a total contribution margin to cover both my fixed cost and then give me 120. So I need a total contribution margin here of 320,000. 200 to cover my fixed and 120 to give me my profit. And I'm going to make 200 contribution margin per unit that I sell. So how many units do I have to sell? Well, you divide 200 into 320,000 and you get 1,600 units. If I want it in dollars, I simply take the fixed cost again, contribution margin, the fixed cost plus the target net income, divide by the ratio, and I get my answer in dollars. So I can predict my profit at any level, or I can predict the volume I need to achieve any type of profit. Now there's one other concept here, very important. It's called the margin of safety. Now this gives you an idea of the riskiness of a company, because the margin of safety is defined as the actual or expected sales that I'm currently achieving or will achieve in excess of what I need to break even. So it's a cushion. If, for example, I'm selling 1,000 units now and I need 800 to break even, I have a cushion of 200 units. We don't express it in units. We express it in dollars, actually. But in this example, I'm using units. So if one company had a cushion of 200 units and another company is selling at 1,400 units and they need 800 to break even, they have a 600 unit cushion. Sales could fall by 600 units before they're not any longer profitable. So you can see by comparing what a company is actually doing to what it needs to do to break even, we can determine the size of the cushion, if you will, i.e. how far sales can drop before they move from a profitable to an unprofitable situation. Now we express this in dollars and we express it as a ratio. So I can take the actual sales, 750, and I look and I've already determined that the break even is 500, then my margin of safety in dollars is 250. So sales can drop 250,000 before I become unprofitable. But a better way to express that often is in percentage. And this is margin of safety ratio. And recall I said a ratio is always a percentage of sales. So the margin of safety ratio is the margin of safety in dollars divided by the actual sales in dollars. And in this case, the margin of safety was 250. The actual sales 750. So the margin of safety ratio is 33%. So the market can go down by 33% until you hit your break even. And so therefore, it's a very useful concept. So there are a number of concepts in this module that you must, again, be very familiar with. Contribution margin in total, contribution margin ratio, contribution margin per unit, target net income, how to determine that, and the margin of safety. Now, on many problems you're going to have, and you have to apply some analysis to, the real trick is to focus on contribution margin. Those three: contribution margin in total, contribution margin per unit, contribution margin ratio.